What's going on, guys? Welcome to an in-person episode of the Energy Roundup. It's my favorite, man, when Robert comes down here. And today we got a big guest. We got Case Van Hoff, CFO, Diamondback. Case, thanks for coming down.
I'm excited.
Yeah,
Thanks for having me, guys.
Man, he's
good to be here.
A low-key Twitter legend. Like, I love seeing you on Twitter. I love seeing, C-suite from public companies represented on Twitter. It makes the companies a little bit more personable. So appreciate you doing that and putting a face to Diamondback.
Yeah, I think there's some really smart people on there. While maybe I don't agree with everything said about Diamondback on Twitter, I feel like it's sometimes my obligation to respond, whether that's a good thing or a bad thing.
Yeah, we were talking about, if you have a public image or a public appearance on Twitter, you have to have pretty thick skin. When you're out there, I think it goes back to the gladiator terminology. You're the man in the arena. So
yeah, you know it well too, Colin.
Yeah, I mean, I'm the brunt of a lot of jokes on Twitter, so I know all about it.
Today's a special day for the brunt of those jokes because today is the year anniversary of oil going negative and Colin's unsmoked pound of weed. So,
there's gonna be people watching that have no idea about that inside joke. They're like, "What are you talking
now
about?"
They'll know.
So yeah, now they'll know.
Now they'll know.
I'm gonna have to give an explainer YouTube video. So we'll do that.
It's
Check
been
the link.
historized on the internet, so you can find it pretty easy.
So, Case, we wanted to have you on today, man, because you in particular were busy over the last couple of months with, just going on an acquisition spree. So you guys acquire Guidon operating and you acquire a QEP announced on the same day. What was it? December 21st?
December 21st. Everyone was very upset with us because they were already on vacation
for Christmas.
And we had to come out with it. But unfortunately, with a public deal and a deal where you're giving up your stock, you have to announce it within a certain amount of days of when you sign the deal. So unfortunately, that was Monday the 21st, and
it's just
and made for a long weekend the weekend before. But we're happy we got it done when we got it done, and the integration's going really, really well, and we're very happy.
Awesome.
That's good. So, I mean, these deals, QEP, correct me if I'm wrong, was $2 billion plus all stock deal. Guidon was $800 million plus cash and stock deal. Is that correct?
Yeah, that's right. I mean, Guidon, we took on their debt, which is $375 million, and then we gave them 10.6 million shares of Diamondback. So that equaled, about an $825 million deal. And QEP, we assumed, in a public deal, you assume everything that happens at that company. So we assumed all their debt, $1.6 billion worth. And then the equity piece was about $600 or $700 million worth, which in public mergers, you do an exchange ratio. What's your stock worth versus theirs? And you set that fixed exchange ratio. So fortunately, oil's gone up, right? And the stocks have gone up since then, but that means we can pay off that debt with some free cash flow or some asset sales much quicker than we thought in December when oil was still kind of in the 40s.
Yeah, I mean, I've seen the Diamondback stocks up almost 75% since the deal's been announced. So,
wow.
How does that kind of change how you guys think about whether it was spinning off assets that came with the purchase versus holding them now? Has it changed your strategy at all?
Well, one, I sleep a lot better at night, right? So I'm actually getting sleep again because there were some tough times last year. But we made a promise when we did the QEP deal that the Bakken, while it might be a core asset to someone else, is not what we do best. I mean, we're Permian focused. We started in the Permian in 2010 with 2,000 barrels a day of production, and now here we are, almost near 400,000 barrels a day of production, and the Bakken just isn't going to be a part of our forward plan. So we're moving to sell that asset. And fortunately, because that asset has a lot of cash flow with it and there's been a lot of activity, that cash flow is worth a lot more now at $60 oil than it was at 40. So
sure, no doubt.
Timing is fortunate, and we're moving quickly to try to sell that asset.
Great. And, we talk about it a lot on our show, just about, different policy implications with Biden and the fact that that's on the res and it looks like Biden's not going to be moving forward as aggressively on the federal lands and ban. Hopefully that, is even better for you guys because there was some uncertainty when you were making that purchase, right?
Certainly. Two risks in North Dakota, federal lands being, the Indian reservation, looked like after the permit ban was put in place, the Indian reservations did get an exemption pretty quickly. And then the big news topic in North Dakota is the Dakota Access Pipeline, which is a hot topic right now. And luckily there's enough takeaway right now out of the Bakken. So those two issues have subsided for now.
Sure.
But, I think if we've seen with this administration, anything can happen, in the first 90 days. And, like I said, it's just not what we do best. We like being in Texas. There's a lot of regulatory certainty is what we call it in Texas, that we can get pipelines built and move our product to market.
Awesome. Well, as you talk about, your bread and butter being in Texas, why don't you just walk us through a little bit how Diamondback's structured at a corporate level? I know guys have got multiple snakes. You got Diamondback, you've got Rattler, you've got Viper. How does the acquisitions of QEP and Guidon kind of fill in with all these companies, and how do you think about that strategically?
Yeah, so we the Concho guys across the street, they call us the snake pit. That's what they call the building Diamondback. Diamondback
how well versed are you with the different breeds or species of snakes at this point?
Now that I live in Texas, I am much better versed in it. But growing up in California, I didn't even think I'd be encountering this many types of snakes. But the impetus of the story goes back to Viper, and Viper was one of the first public mineral companies in the U.S. We basically said Diamondback's ticker is FANG. What comes out of a FANG? Venom,
right?
And that's the ticker for Viper. So Viper was the second iteration, and that came about when we had the opportunity to buy all the mineral rights under one of our largest fields, which is called Spanish Trail. Basically, if you fly into Midland, you're flying over Spanish Trail. The airport area is where that is. So we took that deal, bought the minerals, which we thought wouldn't even be for sale.
Right.
Fortunately, got that deal done and spun that out a year later into Viper because it would trade at a higher valuation. And it has a little bit different strategy, right? It's not, you don't have to spend capital to drill. You just get the benefit of the royalty. And therefore, Viper just distributes a high percentage of its cash flow every quarter. So that's,
sure.
That's the impetus of that story. And then a couple of years later, when we moved into the Delaware Basin, I don't know if you spent a lot of time in Pecos, Colin might have.
Oh yeah.
There's not a lot of infrastructure out there.
Wonderful
right?
place.
Yeah. So we bought Lux and Brigham back to back in 2016, and there was basically zero production or minimal production. And we were going to ramp to 7 or 8 rigs in a matter of a year.
Okay.
Which you need control of your infrastructure to be able to do that. So that was the impetus for Rattler. We built a lot of the infrastructure in the Delaware Basin. There's a lot of water that you got to handle in the Delaware Basin. And, at that time, midstream was trading at a premium to upstream as well. So that, fortunately in I believe it was May of 2019, we sold 29% of Rattler for $700 million, which was basically what we had into Rattler at the time. So that was a nice deal for us. And while we don't like doing 3 public earnings calls in a week, it was the right thing to do for our shareholders. And now we have those 3 snakes out there.
Yep.
And then as it ties to, Guidon and QEP or even Energen, which we did a couple years ago,
sure.
Those 2 subs, they when they trade at a better multiple, you can drop down assets from the parent into the subs.
Right.
And so we want to have all the midstream assets sit in the midstream vehicle and have all the mineral assets sit in the mineral vehicle. And, have a clean story between the 3 companies. Now, some investors will say that's overly complicated, but I think if you look back and say how much money have Diamondback investors made off the 2 subs, it was probably the right thing to do.
Sure. No, that makes sense.
So take us into the mind of, when you guys are looking at acquiring QEP and Guidon, you got super aggressive in December. And I mean, this is before commodity prices had recovered. So, was there any pushback for being that aggressive during that time? And kind of just take us into your insight of what caused y'all to pursue those deals.
Yeah, it's certainly a risk, right? I mean, I basically we had seen what happened in October when you had the big wave. You had Concho, you had
right.
Pioneer Parsley. Prior to that, you had Devon WPX, and some of those were trading well, and consolidation was happening. And we know the Midland Basin very, very well, and in our opinion, QEP and Guidon were 2 of the 5 or 6 really good remaining properties available.
Yep.
And so we decided to pounce a little bit while maybe some of our potential competitors were on the sidelines integrating large deals. So, right after earnings, Travis and I got together and I said, hey, I think it's time to move and take a shot at one of these 2, not thinking we were going to get both, but we happened to work both of them simultaneously. And then as you're pushing up against Christmas, people want to get something done before the end of the year.
No doubt.
And it turned out that both of those came to fruition, within a week of each other. And that made for a pretty hectic 10 days for me. But and our general counsel, more importantly, I think he's got a few more gray hairs after that. But, luckily the counterparties were good to work with. The QEP team was easy to work with. And we fortunately got 2 deals done and announced them back to back. I think some of the analysts, when we had a call on that in the morning on Monday, the 21st, they're a little groggy, because they'd started their Christmas vacation, and I think they missed the first deal. They didn't see the first press release.
Sure, yeah.
And one of the analysts, told me that the deals were leverage dilutive, and I said, no, I think you're wrong. Do your math, and I don't think he had seen the Guidon deal, so it was pretty interesting to get 2 done at the same time. And luckily, if you look at the map, they fit hand in glove, and we're very happy that we got both those deals.
Sure.
Yeah, I remember even when we were covering it on the roundup back in December, I remember writing down, Diamondback acquires QEP, but then I saw the Guidon and I had to do a double take. I was like, wait, did I mess up the company? No, they just went and scooped up everyone.
Back to back. And, you can just see basically a big handprint across Martin County, and that's going to allow for really efficient development. It's good for Rattler. It's going to eventually be good for Vipers, because all the Viper guys now have a new area to buy under.
Yep.
Because not every mineral owner wants to sell, but we try to get as many as we can.
Sure. So from a deal perspective, as you saw these other transactions happening, Pioneer, Parsley, WPX Devon, how did you guys think about pursuing these particular assets? Were they being marketed? Did you call into the companies? How did you guys kind of go about choosing and then engaging the parties?
Yeah, I mean, choosing is really our internal wish list, right?
Yep.
We have a team that looks at the whole basin and says, what would we like to own if we had our wishes, and those 2 assets sat at the top of the list. I mean, most importantly for us, whatever we buy has to compete for capital right away. So that acreage, you basically have to replace rigs that you have operating in other parts of your acreage with that acreage. And with Guidon, we basically said, all right, we're going to drop a Diamondback rig and add 2 Guidon rigs. And with QEP, we said we're going to keep 2 rigs there and accelerate on the Robertson Ranch, which is down in South Martin, Texas.
Sure.
In Martin County, a little bit further south in the map. If you read the background of the merger on QEP, you have to, anytime you do a public deal, you have to talk about who you all talked to throughout the year and all that. And QEP had been talking to a lot of people for a long time, and those assets were highly coveted. But we came in with a credible offer and a serious offer, and that was luckily, taken, seriously, and the board approved it at QEP, a couple weeks after we approached them.
Yeah, that's great.
So do you think we're towards the tail end of consolidation, especially in the Permian, or do you think that there's still a lot of meat on the bone for companies, like Diamondback, Pioneer, Oxy to come in and scoop up assets and companies?
I think we had a lot of really big consolidation last year. While the headline numbers of what the companies were worth at the time were lower because all the stocks were down. Sure. If you look at how much U.S. production moved into the hands of someone else or consolidated into the hands of the top 10 or 12 producers in the U.S., it was a pretty big number. So, I think we're in the middle of consolidation, but I think consolidation's changing. You're seeing this year a lot of deals in the Bakken, a lot of heavy PDP deals with a lot of cash flow moving to private companies or different public companies. So I think we need less public companies in E&P. I think the deals that are going to happen are going to look a little different from the mega deals that happened in 2020.
Yeah, it makes sense. And you kind of get to the secondary basins that are, having some activity, trading hands as well. And, from a midstream perspective, because that's my background and that's what I'm chasing, I'm awfully jealous to see all these upstream deals and PDP changing hands, because it's the midstream landscape on transactions has been extremely challenged, especially just kind of with the gap in, public valuations and private valuations. I mean, the NAV of all these assets are worth so much less than what these public companies are trading for. So nothing's happening. And, it's exciting to see it happening in the upstream side.
Yeah, I mean, you're exactly right. Midstream, service, and minerals to a lesser extent are behind in the consolidation wave because the response from the E&Ps has not been a supply response, right? We're not all growing anymore.
Right.
We're staying flat and generating free cash flow, but we have the commodity price, right? So the midstream guy gets a toll for his barrel going across the pipeline, but that toll doesn't go up because commodity price is up in most cases.
That's right. Yeah.
And so the upstream guys have the benefit right now of getting price benefit versus volume benefit. And the, going back to that consolidation theme, I think having 10 or 12 E&Ps controlling 60% of U.S. production now, and us all doing the right things and saying the right things on less growth is going to make OPEC happier and going to have a healthier market and hopefully a healthier industry for the next 3 to 5 years.
Yep.
On that point, though, do you think that's sustainable if you have, X amount of E&Ps, especially, the, let's say, sub $2 billion companies in the public market and then all the private equity backed operators? How do they maintain the discipline to curtail production and keep OPEC happy? There's something I think about a lot. It's almost, it's like the United States almost has to have a cartel to have some unison in how we deal with OPEC. How do you guys think about that? I mean, obviously, it sounds like y'all's future strategic thinking is to really focus on free cash flow and be an efficient operation. How do you guys deal with all the smaller players that may not have that same goal in mind?
I think about it all the time. It's very topical, right? I saw a stat today. The private operators that have 30% of the production are running 50% of the rigs. But I think a lot of private operators are looking for a way to consolidate as well. I mean, you saw the Double Point guys grow their production a lot to a point where they could sell at a number that they thought was fair. So, I think in the past you had more fragmentation and that 30% of the production that the privates controlled was higher. Mm-hmm. And so big growth on that number actually hurt U.S. production. Whereas now the investors have beat us up to the point where they're saying, guys, I don't want you to grow. And I think what's misunderstood, and there's been many mistakes that shale has made over the years, probably because of an abundance of capital. But at the end of the day, the shareholders own the company, and we work for the shareholders. And for a long time, they really liked the growth until we realized, hey, we're growing too much, and we're going to make OPEC very mad. And I think, as much as I don't want to admit it, our industry rests on the whims of a prince in Saudi Arabia who could wake up angry one day and make things very, very difficult for us, like he did last year. Yep. So that's why I think less growth, higher free cash flow, less debt, more return of cash to shareholders is, feels good. Makes me sleep a little better at night. Like, in the past, we used to grow as fast as we possibly could. If oil went down $5, we're running the model saying, how many rigs do we need to cut?
Yep.
Now oil that goes down $5, well, I'm not happy. You're not changing your plan, right? The capital plan is the same this year. I think that makes the teams happier. It makes them operate more efficiently because we're not moving stuff around all the time.
You think about it in more of a sustainable manner, right?
It's like, sustainable. Yeah.
So, how do you guys really look at the future of Diamondback? How do you get to that point of having a sustainable business? You mentioned, obviously, you got a few variables that an E&P is dependent on, right? It's commodity price. What is OPEC doing? Is someone going to wake up pissed off that morning and do something? How are you guys really looking at driving efficiency and sustainability and getting to that point where you can be free cash flow positive and be in a good place?
Yeah, I kind of frame it as for the last 7 years, you could call Diamondback an acquire and exploit company. We'd acquire an asset, exploit it, grow production to get to scale. Now we're moving to exploit and return, or exploit and distribute, right? We have the machine going, we have the employees in place, we have the scale, we have the credit ratings to raise debt if we need to and access capital. But we're now moving towards a dividend that is growing and going to grow consistently. Get debt down, a little bit more than it is right now. We got some work to do there over the course of this year. And then there's going to be a wave of, you have a couple guys talking about variable dividends, which is basically, your cash flow, free cash flow above your dividend getting distributed to shareholders, or, continuing to buy back stock or grow the dividends. So I think shareholders want their money back.
Yep.
They invested a lot in this industry. And in any business, you got to pay back your investors. And that's what we're well on our way to doing in a consistent and sustainable manner, like you said.
Yeah.
And I think hedging plays a big part of that, right? So, we can't control the price of the commodity, but we can lock in the price that we are getting today. And so what we've tried to do is put a wide range of hedges in that says at the low end, I'm not losing sleep at night over OPEC or actions of OPEC. And that floor is capped, our dividends paid. And at the high end, there's a lot of free cash flow going back to the shareholders, of which, we're all shareholders, and therefore we all benefit together.
And while you do that, that kind of allows you to take a look at the bottom line and your operating expenses and really focus in on those. And so, one of the key themes on this show, we talk a lot about emerging tech and whether it's distributed generation or whatever it is. Have you guys started looking at ways of reducing your LOE through new technology? And is that going to be a focus moving forward for Diamondback?
Oh yeah, we're penny pinchers at Diamondback. I think if you go to our headquarters, there's no private jet and there's no name on the building. And we're fortunate that we didn't have to let anybody go through the down cycle last year. No reduction in force. So I'm pretty proud of that.
That's awesome.
We keep the staff. Maybe they're unhappy when things are blowing and going that they're working so hard, but we acquired these two assets in December and didn't have to add any staff outside of field operations to do that. But back to your technology question, anything's fair game for us. We're looking at everything. I think from a field perspective, electrification of the field as well as electrification of compression not only is going to be great for ESG, but it lowers your cost structure pretty dramatically. So, that's in place. We're spending, I think we've spent probably $150-200 million on in-field electrification over the last 3 or 4 years. And now it's finally coming to fruition, which means your LOE is going to be, for us, kind of low $4 a BOE versus high 4s or low 5s.
That's great.
And when you're doing 300,000 BOEs a day, like last year, 1 cent is $1 million.
Yeah.
And so that's kind of how we like to frame things on that front. So we're open to all the new technologies. It's amazing what the organization did the last year when things slowed down. You really take a look at everything they do, and a lot of the well cost reductions are going to be permanent because of stuff we're changing and new technologies we're adopting.
Yep. No, thanks for that insight.
Before we wrap up here, I want to talk about investor sentiment a little bit. And you mentioned, you guys have the ability to raise debt. You guys actually did a debt financing recently, right?
Yeah. So we closed the QEP deal and we refinanced basically all their bonds.
Okay.
Took out their bonds that were in the 5%, 6% range, and we did a 2-year, a 10-year, and a 30-year deal. And our 2-year deal was 0.9%.
I was going to say it was sub 1%.
Sub 1%.
And it's kind of crazy. Off the top of my head, Pioneer did one. It was also sub 1%, but you even have, some larger private companies that I've heard, are getting low rates, 3-4%.
Mm-hmm.
And that's interesting to me because, if we would have gone back a year, it just seemed capital was drying up. There was no capital for the space, right? Whether it was debt or equity. And that seems to not be the case. You have companies like you guys that are able to access cheap debt. And so what is the overall sentiment for investors? We hear a lot of ESG talk. You hear about all the endowment funds divesting out of oil and gas, but what's the real story? Are people looking to deploy capital in this space?
Well, I think they're looking to do it selectively, right? It's very easy when the commodity's super, super low to point the finger at ESG and say, that's why I'm not making money on the investment. Whether we like it or not, you can run the best oil company in the world. If commodity prices aren't strong, you're not going to generate good returns for your investors. But, I think, and we've taken, the bull by the horns on the ESG front as much as we can. As a public oil and gas operator in North America, we think, your social and environmental license to operate means you have to address the environmental piece. And on that front, investors are pushing that. They're pushing for more disclosure, as well as doing a better job on getting your Scope 1 emissions down or addressing your Scope 1 emissions. So, I think it's a tough question to answer because investors are feeling a little better about the sector, but there is a pretty big distinction between companies they're putting money into and companies they aren't.
Yeah.
And those companies are those that are generating free cash, low debt, have some scale, but also, not just paying lip service to the environmental piece.
Yeah.
And so we put out some pretty big reduction targets. 50% reduction to our Scope 1 emissions intensity from 2019 by 2024, and a 70% reduction to our methane intensity 2024 from 2019. And, I would say that that's a big change for the organization. The people that are just worried about producing wells, producing barrels at the cheapest rate possible and putting it to market and making a profit, now have to think about that other environmental piece of the equation.
Sure. No,
absolutely.
I mean, those are huge reductions. So one thing for me, kind of before we wrap up also, you talked a little bit about people and you talked about not having to lay anyone off. I mean, I'm in Denver, not even in Midland, but the overwhelming reputation of Diamondback and working for you guys is your employees seem to love you and seem to be pretty energized. And so, what is it that you try and drive and focus on the most as far as culture goes? And how do you try and, bring that throughout the organization?
Yeah, I would say in general, we go by a couple rules. We push a lot of our G&A closer to the wellhead because they're the people that matter, right? If you are producing barrels or involved in producing barrels, you're going to get a lot more attention than a guy like me at the company. So,
Sure.
We have a very flat structure, try to keep it, as flat as we can, small teams and smaller teams and support functions versus the actual people that are doing all the hard work.
Yeah.
Yeah, that's great. We were actually talking before we got on camera. He was talking about dress code at Diamondback and how they're casual. I was like, man, I love that. Like, I love just little things in the culture make a huge difference, from having a flat organization where everyone plays a key part. I think that's so important.
Yeah. And while we don't have all the perks and amenities that other companies have, I do think we try to compensate in the 75th percentile, across the board.
Right.
And our top performers should be in the top decile of comp, overall, but we spend a lot less money on the stuff like building a campus or having a bunch of jets.
Sure.
The joke is that our corporate airline is Southwest, and you get a lot of flights out of Midland on Southwest.
Yeah, you can.
Actually, the best flight out of Midland because they use the 737s. You go United, you get in the little the regional jets, and
they're actually on time.
Yeah, and they're on time too.
And I think just lastly, being in Midland is a big win for us as now the biggest public company left in Midland.
Sure.
And the community, being a kid from California that moves to New York City and then lives in Midland, Texas. Who would have thought that became, that's home now for my family and I, and we love it. The people are great.
That's awesome. Well, Case, thanks for coming on the show, man. This has been great insight. So thank you for coming down to Houston, making it happen.
Can't wait to do it again, guys. Appreciate it.
Yeah,
Thank
absolutely.
You.
All right, guys, if you enjoyed this show, make sure to subscribe to our YouTube, share it with a friend. Got to appreciate Case coming on the show. Diamondback, one of the premier operators in the Permian Basin. It's great insight here. So make sure to share it. Subscribe to us on YouTube. Leave us a 5-star rating. Apple, Spotify, that's where you can find the podcast. We'll catch you guys on the next show.